This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Keystone is from December 2011. It's question 2 in the F7 exam. And the time is 16:26. I'm required 2. Statement of comprehensive income, statement of financial position. Notes, as usual, are not required. A statement of changes in equity is not required. Now, that is almost unusual these days because he does seem to be asking more and more for a statement of changes in equity. But anyway, that's fine if he doesn't want one. I'll just put my phone into discreet. Okay, number 6, start again as usual with the last points. Provision for, it's the usual tax thing, deferred tax and current tax, DT, CT. That's where your marks are, your marks are in the workings. Deferred tax, got a brought down figure of 2007 according to the trial balance. And look, it is a trial balance. This is a genuine trial balance where cost of sales has not been calculated, where we've got purchases and labour, and presumably in the notes we'll be given a figure for closing inventory. This is a proper trial balance, which is most unusual. He normally gives us a cost of sales figure. Anyway, deferred tax I've got in. Of course, there's no current tax because that's going to be the accrual for this year. There may have been a balance brought forward, but there isn't. Provision for tax is needed. Here we go. You should by now, please tell me, you should by now be getting used to this. We need a provision for tax of 24.3. There it is. There's a provision, a liability of uncertain timing or amount. It's a liability. It's below these double lines. It's on the credit side. It's a liability. And then the deferred tax. 30 September, the tax base was 15 million less than carrying amounts. This excludes the effects of the revaluation of the leased property, which is presumably higher up somewhere. Tax rate is 30%. 30% of that, we need a carry down figure of 4,005. And that deals with the timing differences without dealing yet with the leased property. Okay, I'm going to get rid of that so that it doesn't mess me up. I would leave it in, of course, in the real exam. I'm not going to close off these accounts until I see what this leased property's got to do with anything. But let's have a look then at point number 5. Equity investments had a fair value of 17.4. Equity investments, according to the trial balance, are equity investments. Oh, there we are, financial assets. 3 figures up on the debit side. Per the trial balance, we've got 18,000 brought forward. Excuse me. We've got 17.4 to carry forward. That gives me 600 movement this year. So we've got that 600 movement. And we have, what does it say? We've not made the election. It's going to be fair value through profit and loss. It's going to be an income statement item. I'm going to just clear my throat, excuse me. Yes, I'm going to put that through the income statement. And that's on the statement of financial position. Item number 4. For inventory was counted and valued at a cost of 54.8, which is good. Nothing much to do there. Closing inventory 54.8, so that's going to be in cost of sales, and it's going to be on the statement of financial position, and it's 54.8. Okay, number 3. The share price stood at $2.40. And on the date, on the 15th of August, that's my birthday. On the 15th of August, Keystone paid a dividend included in admin expenses, and calculated to give a dividend yield of 4%. 4%, dividend yield is is the pence return per pound invested, or the cent return per dollar invested. And we've got an investment of $2.40, so I want to look at 4% of $2.40, and that will give me a 4% dividend yield. And 4% of $2.40 is 9.6 cents per share. That gives me a 4%. 10% will be 24 cents, and it's just less than half of that. So 9.6 cents per share. How many shares are there? Share capital. Down at the bottom of the trial balance, we've got $50,000, but they're 20-cent shares, so there's 250,000 shares. And 250,000 at 9.6 is $24,000 dividend, and it has been included in admin. It shouldn't have been. So I'm going to reduce admin by 24,000, and it's going to come out a statement of changes in equity, but we're not doing one, so we need to be careful. Be careful with that. Before I forget, I'm just going to go back up here and put these figures into... Oh, I can't put the figures for the tax. I was going to say, I'm just going to write these into the question paper, and I can't. I can do that 600. So I'm going to... Where is it? Financial asset minus 600. Yeah. And I'm going to include that as a finance cost, so plus 600 against the 350. In the trial balance, the sixth figure on the debit side is 350 finance cost. I'm going to put 600 there. It's part of fair value through the income statement. Closing inventory. Not really anywhere I can put that. I'll put it against the inventory line, 54.8. I'll put it on the inventory line so I don't forget it. But that's all going to be part of cost of sales calculation. And then 24,000 for the dividend. I'm going to reduce admin by 24,000. Just let me write that in. And I'm going to put 24,000, if I can find it, against retained earnings. Just to remind me that when I'm calculating retained earnings, I've got to take that 24,000 off there. That's for the statement of financial position. Okay, number two. Number two looks difficult, looks an awkward thing. I'm going to skip number two and do number one immediately, and then I'll come back to number two. Revenue includes goods sold and dispatched on a 30-day right of return basis. This is sale or return, this is called. If you sell goods on sale or return, then you're not actually passing the risks and rewards across. You're not losing title to those goods. If the buyer doesn't sell them within the 30 days, then they have the right to return them. So, in fact, this is not a sale at all. It's I need to reduce revenue and reduce also receivables, because they will not have paid me if they're possibly going to return them. Selling price is 2.4. So debit revenue and credit receivables. But if they're not sold, then they must still be my inventory. And I've got a gross margin. So cost plus profit is selling price, 25%, and it's a gross margin, so it's a percentage of selling price. So I need to find out, for the cost, for the inventory purposes, I need to find 75% of this 2.4. And 75% of 2.4 is 1.8. And that needs them to increase inventory and to decrease cost of sales. Because my closing inventory is higher, that's going to reduce my cost of sales. And again, I'm just going to pop that into my question paper. 54.8 I've just written in, but I've just got an increase of 1.8. And cost of sales I don't have. I'm just going to write that against purchases, minus 1.8. Closing inventory. I want to reduce my cost of sales, and so if I reduce my purchases, that will automatically reduce my cost of sales. Okay, and that then leaves me now with paragraph 2, which is looks a difficult one. It looks awkward anyway, it's extensive. During the year we manufactured an item of plant for own use. Okay, self-construct plant. Direct materials and labour were 3 and 4. I'm going to write that into the question because I'm going to use this purchases and labour for my cost of sale calculation. So I'm going to take 3 million off the 64 and 4 million off the 124. I've got production overheads of 75% of labour, and labour was 4, so that's 3 million. That's going to come off overheads. And Keystone determines final selling price for goods by adding a markup. No, come on. So we've got 3 and 4 and 3. We've got 10 million. And if we were selling this, we would mark it up by 40%. But we're not. It's own construct plant. So this is coming off material purchases. This is coming off direct labour. This is coming off factory overheads. And that's going on to plant. PPE. And I'm not going to take account of this 40%. Not allowed to just add a markup on cost like that. The plant was complete and put into use, immediately use, on the 1st of April. Dates, as usual, are important. This is only 6 months. So I'm going to increase plant by 10. I'm going to decrease these items by net 10. And I'm going to depreciate all plant and equipment. So this plant is 10. And the other plant already is 44. Just let me move that 10 over there. The other plant is 44,500. And as usual, with Steve Scott, he does do this reducing balance. Plant and equipment depreciation brought forward 14,500. 30,000 is the reduced balance, and that's going to be depreciated at 20%, which is 6,000. This 10,000 times 20% is 2, but it's only for half a year, so we're going to have 1 depreciation. So those 2 are depreciation. They're going to go, let me guess, yes, cost of sales. So I'm going to just put that against, and again I'm going to write it against the purchases figure. So I'm going to write plus 6,000 and plus 1,000. If I put it against the purchases figure, it means I won't forget it, and I'll be alright. So I've got plant here, which is 24,000 PPE, and plus 9,000 gives me 33,000 PPE. Okay. Leasehold property. Directors have decided, in line with recent increases, to revalue on the 1st of October, so the first day of the year. The first day of the year. So I got leasehold prop. According to the trial balance, it's 50,000, and it had depreciation of 10,000. So I've got a net book value of 40,000, and the directors valued it on the first day of this accounting period at 48. So they're going to eliminate that 10. So it's debit provision for depreciation, not 10. We're going to eliminate 8. Debit provision for depreciation and credit revaluation account, revaluation reserve. So I'm going to debit, well, actually it's TNCA, isn't it? In fact, it's debit the provision, 8,000, and credit reval, 8,000, and that gets me then to my 48,000. But that's on the 1st of October. The lease property was being amortized over an original life of 20 years, and that has not changed. It was being, so leasehold property, when we bought it was 50,000, and it was 20 years, so that's 2,500 a year, so it's 4 years old, and that means it's got 16 years still to go, and we've just revalued it at 48. So 48 divided by 16 is 3. So we've got amortization of 3,000 on the leasehold prop. And that 3,000 is going to go to all depreciation and amortization, cost of sales. So there's my 3,000 coming off the 48. So I've got leasehold property 45 in statement of financial position. I've got 3,000 going to cost of sales. Again, I'm just going to put that into the question paper, and I'll put it up against purchases plus 3,000 amortization, and I'll do the revaluation while I'm at it. Don't have a revaluation reserve, so I need to create one. Revaluation reserve, and that was 8,000. Now then, just think back to this provision for point number 6, provision for taxation, the income tax rate. On that 8,000 at tax rate of 30%, there's deferred tax of 2,400, and that needs to go to the revaluation reserve. It excludes the effect of the revaluation of the leased property. Just let me work that out. Tax base was 15,000, and it excludes the effects of the revaluation. Now, what does that mean? The tax base of the net assets was less than that. That's a little bit vague in my mind, I'll tell you. Oh, that's all there. Oh, I see what it's saying. I see what it's saying. Look, go back up here. It's saying we've got another 2,400 to bring down in the deferred tax account, because this is the deferred tax on the revaluation of the property, and that 2,400 needs to go to the revenue reserve, 2004. And now if I balance this account off 6969, that's 1,800 is going to go to corporation tax. 1,800 comes from deferred tax. If I balance this account off, that's 26,1, and that's going to go to the income statement. That's what it means. Okay, now just let me put that into the question paper. Deferred tax is then going to be 4,005 plus 2,004, that's 6,900. And corporation tax is 24, sorry, income tax is 24,300 liability. I'll just write that in. And the tax charge is 26,100. Just put that CT. I'm just writing this at the bottom of the trial balance. 26,100. Okay, so the net effect on the revaluation is going to be the 8,000 increase minus the 2,400 deferred tax on that increase. Revaluation again, we'll create it, so that doesn't. What's being. I think that's done it. That's it. I think we're ready to bring it all together. I need to do cost of sales, a cost of sales calculation, because we're told from the question. Well, we're actually not, are we? It's opening inventory. Opening inventory is 46,700. Plus purchases less closing inventory, and of course with the depreciation. So we've got material purchases, which was 64,000, but 3,000 of that was our own plants that we constructed. We've got production labour, which is 124, and 4,000 of that was capitalised, 120. We've got the factory overheads, that's 80,000, and 3,000 of that was capitalised. Then we've got the depreciations, can't remember what they were on. I've written them in my question paper. 6,000, 1,000 and 3,000. I remember the 3,000 was the leasehold prop. The 1,000 was the own build, wasn't it? The plant, and that therefore must be the plant. I think that's it for the additions. We've got the closing inventory to put in yet, but additions 700, 6, 7, 14, 24, 2, 10, 20, 31. And less the closing inventory. Closing inventory from the question is 54.8. But there was also another 1.8 on that sale or return goods, so 56.6 was the closing inventory. That gives me 258,100 cost of sales. Okay. So now I've got statement of income. I should be ready to do this now. Revenue, because that's been adjusted, hasn't it? That was 380 minus 2.4. 377,600, and then cost of sales we've just worked out is 258. And I assume you're checking my calculations all the time. 119,005, because if I make a mistake I'm not going to catch it until right at the end. But if you see it, then you make the adjustment. Don't rely on me. Distribution costs 14.2. Admin expenses, all that had been changed, didn't it? 46.4, because we had the dividend included in that. Was that 24? I've written 24,000 in my 22,400 on my question paper. Finance costs 350, and then this non-elected financial instrument drop 950 finance costs. I've got some investment income, which you need to be aware of. It seems to me that pretty well in all questions that he asks, all question 2s, there's some little bit of income stuck in there. So just be careful about that. That's 36,750. 36,750. 82,750. Is that right? I think it is 82,750. I'm sure you'll check again. That's PBT. Tax. Why did I rate it? 26,001. 56,650. And then we got the revaluation. That's P80. Revaluation. That was 8,000, but minus the deferred tax on 8,000, 2,400. That's 5,600. 62,250. Is there anything else? Just check through quickly. I've not written anything else on my question paper, so I assume that's it. I'm hoping that's it. Statement of changes in equity. It doesn't ask for one. And I think I've probably got enough time. This is not for you. This is for your benefit. I don't need to do this. The question doesn't ask for it, but I'm doing it anyway. Shares. Don't you do this in the exam. There's no need. I'm just hoping that it will work out. We've got 50,000 shares. Retained earnings brought forward was 33.6. Revaluation reserve, there was nothing, so that's 83.6 brought forward. And then this year, we've got this year's profits, which was 56,650. And we got the revaluation, which was 5,600. And there was a dividend, wasn't there? I've put the dividend, I put minus 24,000 dividend against the retained earnings. And I don't think there was anything else. I can't remember anything else. I'm going to total it up and hope that I've got everything in. 89, 65, 66, 250. Do we make no, we don't. You know, I've only just thought of that. Note number 2, Keystone does not make a transfer to retained earnings in respect of excess amortization. That could have involved a little bit of a transfer there, a little bit of the net of tax effect on the excess depreciation, but it doesn't do it in this particular question. I've gone through that in previous questions, so I'm not going to go through it again now. 850 carry 1, 4411 carry 1, 9514, 121 850. Does that 850? 11621. Yes, it does. And then statement of financial position. You do not need to do that statement of changes in equity. Please be sure that you understand that. Leasehold property was 48, but then did we not depreciate it? We amortized it by 3. So it was 48 as revalued, then minus the 3,000 amortization gives me 45,000. We've got PPE, which was 44.5, plus the 10,000 self-build, minus depreciation of 6,000, minus depreciation of 1,000, and minus the depreciation brought forward as well of 14,500. So that's 21,500. That's 33,000. I'd already done that, I think, hadn't I? 78,000. I think I'd already written 33,000 higher up. I got the financial asset. It was 18, and I've just taken off 600, so it's 17,400, 95,400, and then we've got inventory, and again that's a little bit awkward, isn't it? It's 54,800 plus 1,800, 56,600. Receivables 33,550 minus 2,400. I've got it written into my question. 31,150. I hope you had. Bank, no, the bank's overdrawn. Again, the bank's overdrawn. He does it so often. It's almost predictable. 170, 183, 150, I think. Just check that, will you? I think it's 183, 150. Shares, well, I can actually cheat, but I won't do. Shares were 50,000. Retained earnings and revaluation reserve. The revaluation reserve, remember, that was 8,000 minus 24, which is 5,006. Retained earnings was 66,250. That was all there was. 121,850. Just check it. Yep. That's equity. Then we've got the long-term liabilities. Now we've got deferred tax. Just the deferred tax not on the leasehold property. What did I write for that deferred tax? Deferred tax, did I write 6,900? No, I didn't, because some of that, it was 4,500, wasn't it? It was 15,000. Was it 15,000 at 30%? Yeah, 15 million at 30%. There is this other 2.4, but that 2.4 is netted off in that 5.6, isn't it? So, in fact, it's not 6.9, it's only 4,500. That 2,400 deferred tax on the revaluation is netted off in that 5,600. Just looking, just seeing if I've got any loans or anything. I can't see any. I can't see any at all. It's not, is it? It's not. Just go back up here. There. The deferred tax is 6.9. It is 6.9. There's the entry to the revaluation reserve. The deferred tax is 6.9. I've got the liability brought down. Plus 2.4 gives me 6,900. That gives me 128,750. Then I've got the current liabilities of Payables, no change there, 27.8. Bank, 2.3. Current tax, where's my current tax? 24.3. There's not normally more than 3 liabilities. We'll do a little bit of an addition and see where we're up to. 50, 15, 21, 2, 10, 23, 2, 4, 6, 8, 183, 150. Yeah, yes, 183, 150. Oh, it's lovely. What a lovely feeling. Okay, the time there, 16:56. 30 minutes. Knowing where you're going, knowing what to watch out for. Standard things, I've said it, I think I said it every time I finish one of these questions for you. The standard, the tax working, it's routine, it should be routine. The equity investments, often in there, it will invariably, the change will go through fair value through profit and loss. Just occasionally there's a possibility it might be fair value through comprehensive income, but it's invariably going to be fair value through profit and loss movement. Most unusual that it gives us a proper trial balance this time. So the note number 4 there, the inventory, the closing inventory, is what tells you it's a proper trial balance. Normally what Steve Scott does is just gives us a cost of sales figure, which may or may not, normally does, need adjusting. Unusual again, paragraph 3, it's not normal that he'll ask us to calculate the dividend to give a dividend yield, but the dividend yield is the cent return per dollar invested. And if you know what the investment is, it's $2.40, you can work out 4% of that, and that gives you the dividend per share. It's actually a very nice dividend, isn't it? I wouldn't mind being a shareholder in this. If I bought shares at 20 cents each and I was getting a dividend of 9.6 cents, that would be phenomenal. Note number 2 is normally note number 1. Those non-current assets tend to be the long note number 1. That's why I left them. Revenue on sale or return, get used to the idea of that. Again, we've got the gross profit and the markup involved in there. He's actually got both, hasn't he? He's got gross profit in the revenue calculation for the closing inventory. And he's tempting you with that markup on cost of 40% for the capitalization of the self-build. But there you go, that's question 2 from the December 11 exam.